Penguin Random House Audio presents The Neatest Little Guide to Stock Market Investing, 5th edition. This is the author, Jason Kelly.
Note to listeners. This program includes a downloadable PDF that contains charts and graphs from the book.
This publication is designed to provide accurate and authoritative information in regard to the subject matter covered. It is sold with the understanding that the publisher is not engaged in rendering legal, accounting, or other professional services. If you require legal advice or other expert assistance, you should seek the services of a competent professional. Publisher's Note: While the author has made every effort to provide accurate telephone numbers, internet addresses, and other contact information at the time of publication, neither the publisher nor the author assumes any responsibility for errors or for changes that occur after publication. Further, publisher does not have any control over and does not assume any responsibility for author or third-party websites or their content. Forward. This book always works. The advice in this audiobook works. It keeps you out of dangerous stocks and shows you how to find good stocks that make money over time. I wrote the first edition in 1996 and 1997, just before the market began its steep ascent into the bubble of the century. Back then, Enron and WorldCom were talked about as must-own companies, and the Internet was expected to put so-called old economy companies like Walmart out of business. Who would walk the aisles of a store when they could shop online in their pajamas? Plenty of us, evidently. In the years following the first publication to early 2012, Walmart stock tripled while most Internet startups disappeared and Enron and WorldCom declared bankruptcy. In 2011, Walmart's annual sales were $450 billion. The two leading Internet merchants at that time, Amazon.com and eBay, had annual sales of only $48 billion and $12 billion, respectively. The subprime crash of 2008 destroyed famous companies like AIG, down 97%, Bear Stearns, down 100%, Lehman Brothers, down 100%, and General Motors, down 100%. Walmart stock, however, gained 20% in 2008. It increased sales and cash flow per share in every one of the previous 10 years and did so again in 2008, 2009, 2010, and 2011. Had you invested $10,000 in Walmart at the beginning of 1975, it would have been worth $60 million at the end of 2011, thanks to the company's steady growth and 9 2-for-1 stock splits. This audiobook would have kept you out of Enron, WorldCom, the dot-com disasters, and the likes of Lehman Brothers. It would not have kept you out of the market's volatility, and no approach to stocks will. The market is volatile in the short term and rises over the long term. On that path, you want companies like Walmart working for your money. This audiobook explains how to find them. Its methods win in flat markets, rising markets, and falling markets because superior companies always come out on top. Invest in them and you'll come out on top too. I also present a value averaging technique that produces steady 3% quarterly growth and bold index strategies for beating the market over time. The Dow dividend strategies and my doubling strategies for the Dow and S&P Midcap 400 offer excellent profit potential. When combined with methods to limit market weakness, they work wonders on your wealth. This audiobook is packed with advice that you can use right away. Listen to it, follow it, and watch your net worth grow. Chapter 1. Speak the language of stocks. Anybody can make money in the stock market. By picking up the phone or turning on the computer, you can own a piece of a company and all of its fortune or folly without ever attending a board meeting, developing a product, or devising a marketing strategy. When I was 11 years old, my grandfather explained to me in less than 10 seconds why he invested in stocks. We sat by his pool in Arcadia, California, and he read the stock tables. I asked why he looked at all that fine print on such a beautiful day. He said, because it takes only $10,000 and two 10-baggers to become a millionaire. That didn't mean much to me at the time, but it does now. A 10-bagger is a stock that grows tenfold. Invest $10,000 in your first 10-bagger and you have $100,000. Invest that $100,000 in your second 10-bagger and you have $1 million. That, in less than 10 seconds, is why everybody should invest in stocks. This chapter further explains why investing in stocks is a good idea, then covers some basic information you'll use in the rest of the audiobook when you begin investing. Why stocks are good investments. You should know why stocks are good investments before you start investing in them. There are two reasons to own stocks. First, because they allow you to own successful companies, and second, because they've been the best investments over time. Stocks allow you to own successful companies. Stocks are good investments because they allow you to own successful companies. Just like you can have equity in your home, you can have equity in a company by owning its stock. That's why stocks are sometimes called equities. Think of all the rich people you've read about. How did they get rich? Was it by lending money to relatives who never repay? No. Was it by winning the lottery? Not very often. Was it by inheriting money? In some cases, but it's irrelevant because nobody has control over this factor. In most cases, rich people got rich by owning something. That something might have been real estate. You learned the first time you watched Gone with the Wind that land has value and that owning some is a good idea. In most cases, though, people get rich by owning a business. School children learn about John D. Rockefeller, Andrew Carnegie, and J.P. Morgan. They all owned businesses. Henry Ford sold cars, Ray Kroc sold hamburgers from McDonald's, Thomas Watson sold business machines from IBM, Steve Jobs sold iPhones from Apple, Scott Cook and Tom Prue sold financial software from Intuit. Howard Schultz sold coffee from Il Giornale. What's that? You never heard of Il Giornale? Oh, but you have, just not by that name. Schultz rebranded it Starbucks after buying the company from its original owners in 1987. All these people owned their companies. I sold magazine subscriptions door to door in school to raise money for the student council. I didn't get rich because I didn't own the subscription company. See the difference? I could have taken some of that money I earned pawning off another copy of Reader's Digest on Mrs. Klein and bought shares of the subscription company. Suddenly, I would have been a business owner, encouraging my classmates to sell, 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 even if it meant they would win the portable radio instead of me winning it. The business they generated would have improved the subscription company's bottom line, and as a shareholder, I would have profited. If all went as planned, I could have bought a dozen portable radios. That's why owning stocks is a good idea. They make you an owner of a company, not an employee or a lender, an owner. When a company prospers, so do its owners. Stocks have been the best investments over time. That's cute, you're thinking, but does it really work that way? Let's take a look at history and a few hard numbers. The stock market has returned about 10.5% a year for the past 75 years or so. Corporate bonds returned 4.5%, U.S. Treasuries returned 3.3%, and inflation grew at 3.3%. Notice that Treasuries and inflation ran neck and neck. That means your investment in Treasuries returned nothing to you after inflation. When you include the drain of taxes, you lost money by investing in Treasuries. You need stocks. Everybody who intends to be around longer than 10 years needs to invest in stocks. That's where the money is. Investing in stocks helps both the investor and the company. Take McDonald's, for instance. It went public in 1965 at $22.50 per share. If you bought 100 shares, the company would have had an extra $2,250 to put toward new restaurants and better hamburgers. Maybe your money would have funded the research and development of the Big Mac, one of America's great inventions. 47 years and 12 stock splits later, your 100 shares of McDonald's would have become 74,360 shares worth more than $7.4 million. Both you and McDonald's prospered thanks to the stock market. How stocks trade. When stocks are bought and sold, it's called trading. So a person might say, IBM is trading at 140. That means if you wanted to
Sample complete. Ready to continue?